So let's talk about captives, and particularly group captives, why organizations own captives, and their upsides and downsides. So what is a captive? Some organizations or groups of organizations make the decision to develop and own their own insurance or reinsurance company. So why do they do this? Well, often conventional insurance is very expensive or unavailable, or they believe that they can manage certain risks better themselves than through a third party. In some cases, for major employers, they consider themselves more financially stable and can cope with large losses better than a less financially sound insurer. And particularly during the recent 5 to 10 years, there's been a lot of examples of that where major clients, some of our clients are really feeling that they are in a stronger financial position than the people that are handling their risk. So captives are an insurance company that almost exclusively deal with the risks of their owners, who believe they can manage these risks more efficiently themselves and they can save money. Captives are typically set up as a long-term risk financing vehicle designed to be in place for decades rather than traditional insurance that might change carrier every year. So organizations moving into captives need a good justification for doing so, but at the same time, once they're in place, they have a very valuable risk management tool that they can use in the long term. In terms of our designing captives, we very much emphasize to our clients that these are long-term investments that are designed to be around decades rather than from year to year. So let's talk about what is driving perhaps some of the moves or interest in captives, and particularly employee benefit captives in the market at this moment in time. Firstly, there's a strong underlying trend towards self-insurance, but also captives are becoming themselves much more established and much more acceptable as a risk management tool to companies. There's a lot of well-known brand names that use captives pretty regularly, but on the other hand, 65% of the Fortune 500 own at least one captive, predominantly property and casualty, but increasingly employee benefits. Captives are established in locations with appropriate legislation known as domiciles. The other driving factor is that since the 1980s, and it's a rather chicken and egg situation, captive domiciles in the US have grown until they're currently over 30 available. So these themselves are competing for the next captive on the block, and there's a lot of developments in terms of services, costs, and specific legislation that needs to be considered as to where the most appropriate captive that you might think about using. The natural consequence of using a captive is that an organization may be moving from a fully insured program with a carrier to self-insurance through a captive. They may move from fully insured to self-insured and then to a captive, but self-insurance is the key step. And for a lot of organizations, that is a challenge for them. They're concerned about the additional risks that they need to take on board and how they might deal with that and what exposures they've got. And so we spend a lot of time running through just the concept of self-insurance alongside what we might say about using captive. If you look at the growth in self-insurance, we quote 3 studies here. One from a recent study from Munich Re showing that 82% of employers are experiencing a growing level of interest in self-funding, and 32% stating that their interest has increased significantly. A lot of this is being driven by the Affordable Care Act and the advantages that naturally accrue to people moving out of a fully insured system into a self-insured system in terms of particularly reduction in certain taxes that are applied to fully insured plans on the healthcare side, and the ability to select which state mandates you wish to adopt also creates significant savings. The other quotation, one from Robert Wood Johnson Foundation, indicates how groups between 51 and 100 employees are more likely to funding greater numbers when they become subject to these new rules. And what we find in the market from our insurer consulting work is that a lot of our insurer clients are starting to offer medical stop loss coverage down to 50 employees. Now, we would not necessarily advocate that as a safe risk, but it is starting to be available in the market, and we caution people, employers of that size, to consider how much risk they're taking on in terms of self-insuring. And you can see the growth of self-insured plans has gone up from about 50 to 52% in the beginning of the decade through to 60% in 2012, which has come from Kaiser. So that's one of the underlying drivers that is increasing the interest in self-insurance and running through the captives now. We look at the types of industry covered by captives. You can see that it's very broad. It's not really focused on any particular market, although you'll notice that there's major penetration in manufacturing, healthcare, and financial services. We operate out of Boston, and we're surrounded by major hospital groups and teaching hospitals, and pretty well everyone has a captive of one form or another. And for those of you who get to Cayman, you can bump into all those Massachusetts healthcare systems out there having their board meetings in December. So it's a very well-established situation. So let's just talk about how captives work. Depending on the domicile and the type of captive, regulators will set a minimum capital and surplus level that owners will need to contribute. This helps stabilize the financial position of the captive. It can be anything from $250,000 up to $1 million or more. Participants then decide for a particular risk how many claims or losses they will simply pay for self-insured retention and how many they will insure through a captive. In an employee benefits example, a company may be paying, say, $10 million of premium and decide to retain $850,000 in a self-insured retention, run $150,000 worth of insurance through the captive, and perhaps a further $50,000 through a reinsurance structure to protect against catastrophic risks. So that gives you the type of structure that typically exists. So if you think about how the premium is developed, we have a situation where on the premium side, the critical issue is to consider that captives are insurance companies and therefore have some inherent risk. The risk exposure is managed by the participants taking on an appropriate level of risk. The captive itself limiting its risk exposure and the reinsurer dealing with catastrophic risks. So looking on the left of this picture, the premium going into the captive covers three areas: the funding of the captive insurance layer in green, operating costs of the captive in gold, and the premium paid to the reinsurer. On the right-hand side, you can see that the employer or business unit may retain cash if the claims are less than the predicted level of self-insured retention, and losses are paid by the captive, and there may be some cash retained at the captive level, and then the reinsurance program kicks in to pay catastrophic losses. So a key element here is that any profits or any surplus that is generated by the captive remains the property of the member or members, accumulates interest, and can be paid back in dividends subject to the regulator's approval. And if you look again on the left-hand side, you'll see that as the group grows, it's possible to rely less on the role of the reinsurer. The captive can take more risk within its group with a larger number of participants. And the operating cost, which has a number of variable elements but a number of fixed elements, can go down on a per member basis as the organization grows. And we'll talk about that in a bit more detail in one of the examples. So the aim is to basically grow loss funds by retaining and managing more risk in the captive and then accruing value in the captive that can be paid back to the participants. So if we now just talk about the group captive structure, Here, a group of organizations come together to fund certain risks more efficiently through a captive structure. This could be anything from medical malpractice to medical stop loss. In most cases, each participant bears some of its own risks through the self-insured retention and then is underwritten for a layer of coverage for the captive and pays for a level of stop loss reinsurance for catastrophic risk. So the same basic structure that you will find in many captives. The key advantages to the participants are that the program can be designed specifically for the participant in terms of the risks that are covered, how it's structured, and very much tailored to a narrow group as opposed to being part of a broad-based insurance program. The group can buy administration and other services in bulk and take advantage of buying large quantities of negotiations in a number of areas. The use of reinsurance, as we said, can be minimized as the group gets bigger. The premiums remain in the captive until used, earning interest, and profits are retained by the member. And then risk can be managed through centralized data and benchmarking. Now, this element of the group captive is often underlooked. We focus on cost savings, and there's a great deal of interest in that versus, say, fully insured arrangements. But basically, the ability to take a particular population and look at the risks of that population, look at the claims that are coming through, benchmark those from one group member to the other, and focus risk management programs is a very strong advantage, and the transparency that surrounds the group captive is a very strong advantage for its members. So there are many types of group captive. The captive industry is very dynamic. In the US, with over 30 captive domiciles, new structures are evolving all the time. We take a conservative view and only recommend well-established structures and domiciles because there's a lot of choice out there, and some areas are more of a safe pair of hands than others. Group captives come in a number of varieties, which we really don't have time to discuss in detail here today, but fulfill different roles from risk retention groups to association captives. The member structures also vary from heterogeneous groups from different industries to homogeneous groups where they have similar industries or risks. In some ways, homogeneous captives are able to take better advantage of the captive structure. Simply by sharing data, benchmarking performance, and creating focused risk mitigation programs, they're able to take advantage of the experience of groups in a similar industry. And again, we'll talk a little bit more about that in one of the examples. Here we look at a couple of examples of group captive structures. The single captive group is owned by its members and may place risks directly or for many property and casualty risks via the selected agent, broker, and a fronting company. The fronting company is often used to ensure the captive can be licensed in multiple states. In the case of employee benefits, it's often possible to not use a fronting company, and there's certain costs involved in having that in place. The self-captive structure reduces the cost of establishing a captive by members or groups of members renting cells from captive owners or self-captive owners. These can be designed to ensure each member is only responsible for its own risks within each cell, insulating the liability from the others. There are a variety of self-captive structures, and they vary by domicile and how they work. And they work for different member situations. And in our process, we typically review a number of captive domiciles and a number of self-captive structures to see what best suits our client. So that's a little bit of background about captive structures, and I'm going to pass you over now to Ryan, who will talk about how to put a captive together.
Yes, good afternoon. If you want to go ahead and advance that slide, I guess I'm doing this. Establishing a group captive. This is some of the most important considerations. I think probably quite a number of you are thinking should I do a captive, period? And then if I'm going to do a captive, would a group captive work for me? I imagine that's why you're on this webinar. One of the most important considerations is to find like-minded companies and people. And there's a lot out there. We've worked with a number of groups that are looking at their insurance purchase and saying, should I continue to pay these premiums? I don't experience the losses to the extent I'm paying premiums. Is there a better way to do this? And I'm here to tell you there's a lot of people out there looking for like-minded people to put together group captives to manage and control their risk exposure going forward and their premium costs. And we'll talk a little bit more about the benefits in a minute. Sometimes it's important just to find a common friend or an enemy, something that is not working for you. Sometimes it's almost as much a motivator if your coverage is being constricted or if you're not finding the coverage levels that you want and you need to have a higher limit of insurance. Sometimes groups will get formed at that point. Important to establish the main objectives of the program. You're going to focus on safety and loss control. In a group program, if you cannot impact safety or loss control, it's especially on the property and casualty side, it would be worth your time to really stop and take a look at whether you should be part of a group captive. On the employee benefit side, it's a little bit more soft as far as how you could manage the risk inside the captive. Sometimes it's just a better funding mechanism. Premium reduction should be a goal, an objective, and then coverage terms expansion seems to always be a goal of a group captive, trying to find a better program for your type of risk. Who should consider a captive? Companies primarily with good risk management, where you do the right things, you expect your losses to be less than what the insurance company is going to pay out. You're going to beat the market. A long-term commitment. You should expect the captives take a while to play out. They're going to be there for a while to average out your cost over time. Should be financially sound, not just looking for a quick fix to a really bad problem. Those are typically not good captives to set up. Driven by an interest in financing assumed risk positions. So if you have risk positions that you feel are unfinanced and you're going to have volatility in earnings, you could put together a group captive to put money aside into the captive with other people to smooth those earnings over time and get a dividend of good results. So when there's a bad year, you have funding set aside to pay for that. Again, reasonably predictable insurance risk. You wouldn't want to put risk that could hit you and bankrupt the company, the captive, quickly, looking more like cyclical type risk. You want something that's a little bit more predictable and longer term risk. And then a transformer transaction, where maybe the captive is providing insurance to the group members, and then the captive is going out and entering into ISDAs or different hedge positions to manage the risk. We've seen some groups that have exposure to weather get together, form a captive to provide solid insurance back to the company so that they can show their board as good risk management, and then the captive would go out and take weather positions to hedge themselves as a way to manage the risk in an aggregate level. So there's many good reasons why you should consider putting a captive together. Should not consider if you have poor risk management, high loss ratios. That's pretty much a given. If you are benefiting from your existing insurance, then a group captive is probably not that interesting to look at. Gord, if you have a short-term outlook or if you're price-driven, if you move companies year to year, again, a captive is probably not the right thing to look at. You want a long-term commitment. If you're financially weak, you may not want to tie up some capital in an investment in a captive. That may disqualify you. If you're in a highly volatile or catastrophic exposure without the support of other lines of insurance, those may be risks that you do not want to put in the captive. Key considerations when forming a captive then is we put 5 up here. There's a lot of things to think about, but the 5 primary ones: captive type. Would you want a pure captive, one captive that insures all the group members, or a group captive, more of a type of a structure where each group member would have its own captive, and then the captive insures into a pool, as John shared earlier. If you want a fronted company where you have a licensed insurance company that would issue the policies, have credentials to issue certificates of insurance to contractual insurance requirements. Those may drive what type of company you put together. You'd probably prefer direct in most cases, strip out the fronting costs and the transactional costs, and be able to pool your resources direct into a captive, much more cost effective over time. Not all programs are allowed to do that. The captive legal structure, the owner, or in some cases sponsors that get together and put together captives, would look at what the structure would be from a stock, or whether it's a mutual reciprocal. Again, the cell structure, where there's multiple different cells that have could have different ownership legal structures. And then rental captives. It's another option where someone else has put up the captive and you are using their captive and you pay them a rental fee for the capital that they've placed in the captive. Tax issues, deductibility of premium, what's the accounting. There's a way, if you put a captive offshore, you can do so it's called a 953B election to be treated as a U.S. taxpayer. There's another section of the code, 831B, that if you have a small captive where your premium is under a certain dollar amount, you can set up this captive and the premiums paid in go in tax-free. There's still taxes on investment income, but the operating profit would not be taxed at the captive level. So there's some very creative ways to set up the tax structure so that it meets your needs. Domiciles, there is, I think it's 28 or 30. It changes almost monthly now, the number of domiciles that we have available in the U.S., and then there's some very solid international domiciles. These are combine that with the box down below, regulatory compliance. There's some very decision criteria that are needed to determine which domicile fits best, which has capital structure that meets your needs. What might be the type of programs that are most favorable in different domiciles. Each domicile typically has their core advantage or strategic advantage. You need to evaluate those before you select the taxes that are collected, and the domicile may come into play based on the type of program you're setting up. So these are some of the key considerations when forming a captive. So the other thing you want to make sure that you identify upfront early in the business plan is the risk that would be insured in the captive. There's a plethora of risks out there. On the property and casualty side, professional E&O, there's many medical malpractice captives that have been set up as a group structure where they share in the losses and manage the risk and are very profitable. Product liability, I know some farmers and some ethanol groups and other companies that have a similar product liability exposure have gotten together because they believe the market has mispriced their risk, and they pool their resources for product liability, and they have tight controls and standards that they live by to lower the risk, and over time they're paying themselves dividends back in the group captive. Workers' comp, employer's liability, required insurance in most states rather than paying the premium to an insurance company and not seeing that anymore. Many companies have used the cash flow benefit of paying that into a captive. Property damage is becoming more common to take a layer of property insurance and put it in the captive, share that with others. General liabilities we talked about, auto liability, and pollution, environmental. On the employee benefit side, some of the most applicable ones to group captives are group term life, the stop loss, inerrant and active, and retiree medical and dental, where you take a layer or maybe the high end of the risk profile and put that in your captive, aggregate it with other people so there's a good spread of risk, and it's a very effective funding mechanism for the dental cost and the medical cost, which seem to be increasing every year. Disability is another good program to consider looking at a group captive structure. This graph is maybe a little bit busy, but let me just go through a little bit of this. What you're looking at on the left-hand side is different considerations, things you'd want to consider when you're evaluating whether you want to have an insured program, the middle box, or a captive program. Kind of a decision tool to help you evaluate each different program. Should I put this in a captive or would I not? Obviously, an insurance purchase program would be an insured program. On a captive program, you would only rely on insurance, typically for catastrophic losses. So you'd want to fund into the captive those risks and those losses which should generally be paid out of the captive. And then if you had catastrophic losses, you might use insurance above that to purchase an excess layer. Pricing model, an insured program in the marketplace is going to set the pricing, but you have no return if you control the losses. You still have to pay the premium. In a captive program, it's loss-based. There's different models that could be used, but at the end of the day, your potential for profit is much higher because you can modify your pricing tool to include your experience in the captive model. Volatility, I mentioned this already, that the cyclical, really unpredictable nature of an insurance program is better for the insured market. A little bit longer term, more stable is better for captive programs. Savings, if you put premium in the pot and you don't pay it all out in losses and there's money left over, of course the insured company gets it in a captive program that accrues back to the owners. Same thing with investment income. It's one of the benefits of the captive program is that you get the investment income over time. And insured, the management effort, obviously there's more effort involved in a captive program. In a group captive program, it might be not as much as you think. There may be some people in the group who want a leadership role, who serve on a board or a committee. If you're not that type of want to be involved in a group captive, oftentimes you can just go to the board meetings and read the minutes, keep involved, give your ideas, but you can. It's structured more similar from a management commitment to an insured program. The upside potential, and I think I wrote this a little bit wrong, but on the insured program, you only win if your loss payback is greater than the premium that goes in. In a captive program, it's the other way around, is you win when you keep your cost of losses low. And the services, typically in an insured program, they're bundled. In a captive program, it's very common to unbundle those. So you'd have one provider that would provide the insurance or risk transfer or the fronting. Maybe you'd contract with a different provider to provide claims managing or the fronting service. So just getting right into cost savings, what could you expect to save? If you want to put a group captive together, what are other people seeing? And this is from experience with multiple different captives and programs. On the property casualty side, typically you see an immediate benefit. The premium that goes into the insurance market, most insurance companies, not a knock on them, they just have administrative costs, but typically a load of administrative costs factored in around 30%. With a captive, the administrative burden is typically about 10%. So immediately, if you're taking money out of the commercial market and putting in your captive, you should see a savings of about 20% just in the reduced administrative costs. If you can also align incentives now that you're taking on risk and lower your cost of claims and save them by 20%, you can save 20% claims, not unheard of, 20% administrative costs. You can get up to 40% of savings just by taking your risk and refunding them into your captive. On the life, retirement, medical difficulty, multinational benefits, you can see some additional savings there. A lot of these savings are also generated by having a new competitive pressure in the marketplace. When your captive is taking premium out of the marketplace, you see the carriers get more, they sharpen their pencil, and they get more competitive, knowing there's a new competitor. So that's some of the additional benefits you might see, just providing competitive pressure. As a group, you're aggregating your exposure. You may be able to leverage your purchase as one point of contact into the marketplace. Insurers will give credit for that rather than renewing 25 individual policies. As a group, you're renewing one policy and then passing that benefit down to your members. Some of the other advantages include broader coverage, stability against market fluctuations, improved services, a lot of times direct access to reinsurers that may not want to play in your market or your area or our country, and you can go direct to these reinsurers as a captive and, again, leverage by. And then increased claims control, a very important part of this. Go to the next slide is how to establish a captive. So a couple slides are just right into how you put it together. The first step in the rock pile there would be conducting a feasibility study. You'd want to look at loss history, discuss the potential benefits, what the capital requirements would be, how the ownership structure would look, do a financial analysis, really back of the envelope, high level first, and then look at legal requirements. If it's an employee benefits, does it trip up in ERISA concern where you would need DOL approval and a letter exemption. Look at the different taxation and incorporation. You'd also look at an actuarial review. What do the numbers look like how big a pool are the losses? What did it look like over time? What type of investment income returns would that generate? What's the cash flow? Selecting partners, should be very careful to select the right partners in the different relationships in the insurance industry and the other members coming into the group. How you'd set up the corporation, licensing, again, just mentioned capitalization. The reinsurance contract, if you're going to rely on any reinsurance behind the captive, how would that look? The insurance contract up front, whether it's a fronting contract or a direct policy, how would you build the direct insurance policy? How would that look putting in place in the different states? Different service provider agreements, and then again the DOL. If you do need DOL approval, you want to factor that in and make sure you have enough time to get that agreement. So we look at exactly how to put it together. There's a development process that we use. Phase one, again, we talked initial analysis, really a high level. This typically use a captive consultant or sometimes use your broker or somebody else to look at the data collection and initial analysis of what the program would look like and just your initial kind of high-level financial implications. Really, does it make sense? Is there enough premium? Is there enough interest from other like-minded professionals and companies that want to go into a group captive? And then if there is, if you get enough thumbs up, go to phase two and look at the formal feasibility study. Again, this is a captive consultant would do this. They would probably involve an actuary and a legal representative to make sure the documents are structured in a way that goes out and shares with others. Develop the optimal program parameters that would come with getting maybe a core group of the bigger group together. Oftentimes you have a committee, a smaller committee like an advisory committee from the bigger group that would get together and discuss how is it going to work from a new member standpoint. Is there any membership fee that goes into your what kind of coverage is it going to be? What's the premium? What's the capital that's going to be required based on the premium that's underwritten? You would have someone put together fronting and reinsurance options based on the risk profile and the risk management strategy of the captive. You determine how much risk you'd want to lay off or retain in the captive and want to protect the capital structure as much as possible. You use actuaries to look at the actuarial analysis, which is the important part down the road when you submit your implementation plan to the regulator, the domicile select. You would need an actuarial analysis, a business plan, the tax and legal analysis, and a pro forma financial statements. Typically go out 3 to 5 years to show there is potential for loss, but there's also potential for profit, and it helps drive what are some of those considerations that you're building into those options. The phase three, you want a captive program of implementation. You want to do the incorporating, get your license set up the captive, build the insurance program, and secure the capital commitments from your group. That typically looks like a confidential memorandum that's rolled out to the larger group to allow people to have discussions on what are the requirements to join the captive, and it goes into a lot of details, and it would help be full disclosure for those who want to come into the captive. And typically you look for just a small group, maybe 10 to 15 different groups. It could be smaller. I've seen as small as 5 groups. Members get together, form the captive based on advisory committee discussion, and then you roll it out to a broader group and start signing people up through your screening criteria and based on what you've agreed to the captive would look like. So benefits and drawbacks. I might go a little quick here just because we've covered so many of these in other areas. The biggest one is cost management. You want to save money. You want to do cash flow management. You want to reduce the frictional costs, take out that 20%. You want to capture investment returns, increase control. As an owner of the captive, you have a say in what the coverage looks like, what the provision, what the benefits might look like if it's the employee benefits captive. You're going to have improved data management and claim cost management. You will be able to see what your losses are, what the group losses are. Again, you're pulling back some of the profits that might be going to an insurance company, so you're controlling your destiny in funding those profits into the captive, and you improve reporting and hopefully understanding of the risk. The more involved you are in owning your risk and in managing the captive, I've seen many people have a better idea of how to go back within their company and minimize their risk. Improve risk management, this is an important part, is just, again, going back and manage your own risk. You create a central risk pool, better data and data analysis to go back to the group to put together standards or loss control information. This speaks highly to the reinsurers, which often allows you to go back and lower your costs more. Once you understand your risk, you can reduce your risk, and then you sell that into the reinsurance market and lower your costs. Additional captive benefits. Your program benefits for the members include buying power. Again, it's leveraging your ability to go out in the market to lower your costs, transparency, more visibility to your own losses, to what the costs are of the real program, allows you to negotiate better terms when you break down how much the fronting costs are and how much claim servicing costs, rather than buying a bundled product today where you don't even know what the costs are. They just say it's $100,000 and you pay that out and you don't know where it's going. In this case, you'd have much more visibility and more leverage in negotiating each part of that as a group. Flexibility, how you spend the money, how you design a program and employee contributions and maintaining relationships. One central point of contact, very important for reinsurers to get very excited about these group programs. They want to give premium incentives to form these, because right now they may be reinsuring 20 different individuals or insuring 20 different, and if you can aggregate that risk profile, you lower their risk, and you lower their contacts with 20 people down to one group, and it's a way for them to lower their costs and to save you money. Control, again, we talked about premium. Over a large scale, the premium cost should go down and you have control over that. And then choice. Many times you don't have access to a lot of different insurance options or insurance companies, and as a group, you would have much more pull in the marketplace to attract markets into your program. Drawbacks, there are a few. It's a long-term commitment. You've got to stay in this for long-term. A lot of captives have a vesting period, maybe 2 or 3 year vesting period before your capital becomes yours. So that's also a good thing. You don't want companies that are jumping in and out of it. It's much more difficult to predict where the market's going to go and what your costs would be that you spread amongst the group. You're part of a group, a team environment. Sometimes I like to say it's like herding cats, but everybody comes to the table willing to work. They have skin in the game, and it's a really good environment when it's a team environment working together for the same thing. We're not competing on safety and risk management, so it's a good place to share and to learn. Need to compromise on requirements. Sometimes you don't get everything you want out of the deal, but you have a voice, which is more than you would have in an insurance company, in a commercial market. You accept responsibility of being an owner of a small insurance company. That's a big commitment to some people, putting the capital in and being part of it. It's a great experience for those who embrace it and want to control their own destiny. Dollars potentially at risk for others' losses. There's ways to manage this. You try to manage it through reinsurance agreements or through standard or through selection. You make sure you select the right kind of risks that are coming in, being part of your group. You build exit strategy, and then dividend strategies are more long-term. It's not get your money out tomorrow as some programs, some guaranteed programs are. It's a long-term strategy of getting dividends out. Case studies. We've got a couple case studies to go through, and hopefully it puts a little bit more teeth in how these things work. One case study is we worked with a group of actually a customer, a sponsor came to us, an owner of a company, and said, we would like to build a captive insurance program for our customers. Our customers aren't able to buy the insurance that they would want to buy in the commercial market. How do we structure a program that does a better job of giving them the insurance? We also have products that we want to guarantee and that we want to put some bang behind our guarantee. So we'd like to offer this insurance and sponsor a captive. And the members were a homogeneous group that have a diverse size and geographic distribution. The sponsor and the members both contributed capital. The Spring provided the program management, underwriting, marketing, new member orientation, administration. So there was a lot of the functions that were outsourced to one group. So there was a central point. This sponsor wanted more of a turnkey. They didn't want to have to run an insurance company, but they definitely wanted an insurance company that their customers could own and participate in that provided them the benefits that we talked about earlier. The captive would purchase stop loss and aggregate loss protection to minimize. So just that graphic down below, the members created an incremental capital into the captive insurance company. The sponsor also provided capital. The captives relied on reinsurance to minimize the amount of capital required in the captive. And then the insurance provided through a fronting company and through agent brokers. And then the relationships were managed with one organization being the pivotal point of contact throughout this. Now, that was Spring in this case. So, problem defined. The customer need, they were exposed to significant fluctuation in revenue, and they really wanted cost savings out of this. And they wanted to provide, the market wasn't providing the coverage, it was inadequate for their increasing demand, and there was no continuity in the market. They would have to move from insurance provider to insurance provider to provide their type of coverage that they wanted. So the captive concept tried to deal with these. The group members, they had a common interest, they had aligned incentives, and there was a way to mitigate the risk for the entire group. Those standards were put in place. The captive provided a vehicle to select risk and to control their terms over time and give better coverage options. The group aggregated their premiums and improved the buying power and lowered their costs. And the captive had a much lower administrative cost than what the commercial market, and those savings went back to the members. So the custom solution is working with leading reinsurers. We're able to leverage the group's strength and the buying power to increase the terms. The captive is now designed the coverage terms and set their own selection criteria. The members own the captive and contribute the capital. They share in the profit and the loss. That profit and loss has been mitigated again by a reinsurance that only puts so much capital at risk. I think we have 40% capital at risk any 1 year, invested capital until we hit our stop loss aggregate protection. The customers have a more secure insurance future, and the sponsor has a more secure relationship with its customers and a link now that it didn't have before. The costs were reduced by 20%, and on average, the customers are buying about 20% more insurance even with their costs reduced. So I want to turn this, one more item on this, on case study 1, on the spread of risk. One of the areas that allowed us to lower the cost, and I mentioned this a little bit earlier, is that we were able to spread the risk of each individual member over a group portfolio effect of risk, which allowed us to go to the reinsurance market and buy lower amounts or spend less on the same type of coverage. Imagine each one of these members, if there's 7 members, each one going to the market buying insurance for their own risk. The pricing was much higher than if they aggregated and spread the loss. We could take a higher deductible and retention as a group. So that orange section in there was basically the quota share and stop loss aggregate protections, which was much less expensive to purchase than to buy individual insurance. And then we're able to extend the type of coverage up so that they had higher levels of insurance protection. So John, I wanted to turn this over to you and allow you to talk about the second case study.
Thank you very much, Ryan. I just want to say that we've got a couple of questions. We're running over a little in terms of time. We've got a couple of questions. I'm going to run through this second case study very quickly, and we'll get to the questions. If you have other questions, please ask or type those in now. But this is an interesting case history of a homogeneous group medical stop-loss captive that we recently put together. And you can see from the above diagram what is typically happening at a local level and what we're trying to deal with. So you've got a situation where these are organized employers in a local market, generally using the same group of health insurance plans, but buying individually and buying services individually. in many cases, they're buying from the same providers in isolation, and they're just getting no economies of scale. These participants are sized from about 100 to over 2,000 employees. So what we're able to do with the captive structure is to create a number of layers of efficiency. As you can see, that through the Consolidated Health Plan, we're able to provide services to and a range of health insurance plans to a variety of participants. And in consolidating and centralizing the program, we can start to buy cost effectively and select best-in-class programs such as wellness, employee assistance, behavioral health, etc. And that's the sort of efficiencies we can drive through. So in this particular example, there are the initial group of around 25 employers with about 9,000 total employees, and they're spending just over $100 million a year on health insurance. By funding, initially, our conservative view that by funding their stop-loss health insurance through a captive, the group will save over $6 million a year on their health insurance costs. And if you start to move that out, we think the 5-year net present value savings will exceed $30 million, and additional savings will come from better health management, reduced reinsurance costs, and further savings on administration. So we have a platform here to create some very strong health improvement as well as cost savings. So this representative sample across the top is what we're anticipating. This was a study that we did in 2011. The captive's just been launched and is actually demonstrating slightly better than those figures now. But our projection, we have about 60 employers in the same group interested in this program. There's about 100,000 employees. They're currently spending $1.2 billion on health insurance, and we believe that the savings can be $180 to $250 million per year, and that will improve with volume. So these are, 100,000 employees is a small village, and you can therefore, in terms of health management, do some very interesting things there. And then secondly, the savings can be pretty substantial. So lastly, where does this go? And I think this is the really interesting part, is that with that as a base, it's possible to develop the program in a number of ways, and to move it from simply saving money on health insurance costs to actually creating a basis for improved productivity and wellness and efficiency. So improving the health of the group and adding in other programs that we can address, such as disability, looking at things like in-house primary care, health and wellness initiatives. So generally, just looking at the return on investment we can get through here, it's an excellent platform to make a real difference in terms of that population. So that's something that we think is pretty interesting. So that's the end of the formal part of the presentation. As I say, I have a couple of questions here, one is saying, what are your expected savings of putting a health insurance plan in a captive? Well, the previous example is a conservative view of what we think is possible. This was generating 5 to 6% savings initially, but once you start getting volume involved, buying the administration more effectively, impacting the health management, then you're starting to get into double-digit savings rapidly because of the tools that you have available to you. The second question was somebody who said, that they have an association, and how can they introduce the idea of captives? And we've worked with a number of associations where basically in surveying the members, the employer associations, a lot of the members are saying that one of their issues, the most important issues, is the escalating cost of health insurance. And therefore the possibility of using the structure of the association to build a captive to create solutions for members is very possible. So what we typically do is that we work with the association management we get a group of association leaders together, talk them through the concept. We work by surveying the membership and the level of interest, do basic feasibility studies to demonstrate the value, and then roll it out from that point of view. If there are a group of employers that work together in other areas, in some cases they're doing joint marketing or joint purchasing in other areas, all the better. They're used to working as a group. Some cases there are existing property and casualty captives that this type of program can be added.
John, I see another question on here. Are there any differences or restrictions with nonprofit versus for-profit enterprise? And there would definitely be different considerations if you're trying to get a tax efficiency in a captive. Obviously, that would not play if you're a nonprofit. But the benefits of reducing some of the administrative costs from your insurance program, aligning incentives with your group to control costs so that the loss funds that go to the captive that are not paid for losses come back as a dividend to the group still, all that still comes into play. Those benefits that you see in increased control and cost savings still come into play even for nonprofit organizations, and in fact are some of the very impetus as to why you would put together a captive, because your nonprofit group is very interested in those financial projections. John, do you have any other comments on that one?
Yeah, we've been working with a group of major charities, and as Ryan says, the tax benefits that might accrue to certain captives wouldn't apply in these circumstances. But these are all 501c3s, and they are spending still an enormous amount of money on health and disability and life insurance, and they are looking for a vehicle to consolidate their programs to be able to manage those risks effectively, to drive some more effective administration and return money to their, to use more money for their causes. The calculation we did for that particular group demonstrated that, with, 10 or 15 major participants, they would save about $180 million a year, which is a lot of money in terms of the good work that they do. One other question we have here is, how long does it take to set up a group captive? Well, I try to do at least one in my lifetime, but they can take rather long time depending on the group. So part of the program is to really select groups that have a realistic chance of getting together, and that's around how much they work together in a current form, how homogeneous they are in a lot of ways that they have similar risks and issues. So it can be as quick as 6 to 9 months to put something like this together. It can take longer, but starting off with the right group and strong interest, you can get at least a core group of members underway, and having got that core group underway, you want to design it so that other people can join easily. So, for example, one of the things that we do is that we say, okay, you can join the captive on the anniversary of your health insurance or other insurance, so that it is one of the transition points of moving their enrollment period is eliminated. In most cases, that generally indicates that they're joining in July or January, but in some cases it's not, and we will take the issue or the rating issue of managing that off date enrollment and deal with that for them, just to enable them to smoothly transition.
John, the question of how do you finance, how do you even pay for initial feasibility study to get a group going? I've seen many times where either a sponsor, one group that is going to benefit from this, or a number of different groups that have some issues in common will pull some money, and we'll have a feasibility study done, and then we'll bring it out to the larger group. And once the captive is formed, many times there's an entry fee to join the captive, and that entry fee goes back and pays back either the sponsor or those companies that paid the initial fees, the feasibility study fee. many times the captive then goes back, collects that initiation fee to pay back those members who fronted the money up in the beginning. So there's many ways to set that up and ways to fund it so that it's not an impact to one organization.
And I think the other thing is that to some degree the desire of the group to get to that stage and to fund the initial feasibility is from our perspective, one of the ways that you test that the group is serious about it. But as Ryan says, it's very easy to set up so that once the captive starts to generate surplus and it's suitably retaining enough surplus and has excess, then you can make it a priority to pay back those people that have invested in the initial program, and that's in our sorts of captive quite commonplace. So, any other questions? I think we've done all the questions that we've got. It's 2:59. Thank you very much for your time. We really appreciate you participating in this. Look out for others in the series, and if there are any non-webinar questions that you have, please contact us. We'll be sending around a copy of the slides, and our details will be on there, and we'll be happy to answer any individual questions with you at any time. Thank you very much indeed.
Thank you.